On the 15th of September, 2008, the investment bank Lehman Brothers Holdings filed for Chapter 11 bankruptcy protection in the Southern District of New York. The filing listed assets of approximately $639 billion and liabilities of approximately $613 billion, making it the largest bankruptcy filing in the history of the United States at the time. The bankruptcy filing itself took less than an hour to process. The consequences of what it represented took years to fully resolve, destroyed trillions of dollars of financial and economic value worldwide, pushed millions of people into unemployment, and produced a period of global financial contraction that has since been called the worst economic crisis since the Great Depression of the 1930s. Lehman did not cause the crisis. The crisis that Lehman's failure made visible and dramatically accelerated had been building for years inside a financial system that had developed increasingly complex ways to originate, package, sell, and leverage exposure to American residential mortgage debt, without anyone in the chain of that process being required to maintain sufficient understanding of the ultimate risk they were taking on, or sufficient capital to absorb the losses when the underlying mortgage market began to fail. The mechanism through which Lehman and the broader financial system built up their exposure to ultimately unpayable mortgage debt runs through a financial instrument called a mortgage-backed security, a bond that pools together many individual mortgage loans and distributes the monthly payments made by borrowers to holders of the bond. Mortgage-backed securities have a legitimate economic function. They allow banks that originate mortgages to sell those mortgages to investors rather than holding them on their own balance sheets for decades, freeing up the bank's capital to originate more mortgages and providing investors with access to mortgage returns without needing to originate mortgages themselves. When the underlying mortgages are sound, made to borrowers who can realistically be expected to repay them, the pooling of many individual mortgages into a single security actually reduces risk through diversification, since not all borrowers are likely to default simultaneously. The problem that developed in American mortgage markets between approximately 2002 and 2007 was that the standards governing who could be offered a mortgage deteriorated substantially. The originate-to-sell model, in which mortgage lenders receive their profit from originating a loan and immediately selling it, retaining no exposure to whether the borrower actually repaid, created an incentive structure that rewarded volume over quality. Mortgage brokers and lenders could make money by originating loans to borrowers who could not realistically sustain them, because those loans were immediately packaged and sold to investors, and the originator's profit was made before the loan had any opportunity to perform or fail. The investors who purchased mortgage-backed securities built from these loans were, in many cases, relying on credit ratings, assessments of default risk assigned by rating agencies like Standard & Poor's, Moody's, and Fitch that proved to be dramatically more optimistic than the underlying loan quality justified. The rating agencies were using models that underestimated the correlation between defaults, the tendency of mortgages made in the same period under the same loose standards to fail simultaneously when housing prices stopped rising, and that had not been stress-tested against a significant national decline in housing prices, which had not occurred in the modern era. Lehman Brothers was, by the mid-2000s, deeply involved in the origination, securitization, and retention of residential and commercial mortgage-backed securities on a scale that made its own balance sheet highly vulnerable to a deterioration in the mortgage market. In the years leading up to the crisis, Lehman had expanded its exposure to real estate both through holding mortgage-backed securities and through direct real estate investments, using leverage, borrowed money, to amplify the returns for what appeared to be a steadily appreciating asset class. By the fiscal year 2007, Lehman's leverage ratio, the relationship between its total assets and its equity capital, was approximately 30-1, meaning that for every dollar of its own capital, Lehman was operating with $30 of borrowed capital. At this leverage ratio, a decline in the value of its assets of just 3 to 4% would eliminate its entire equity, the buffer that protected its creditors from losses. The American housing market peaked in 2006 and began declining in 2007. As housing prices fell, the value of mortgage-backed securities declined. Delinquency and default rates on the underlying mortgages began rising, first on the subprime loans that had been made to the least creditworthy borrowers with the loosest underwriting standards, and then spreading to other loan categories. The credit rating downgrades and realized losses that followed began flowing through the financial system, revealing the extent to which the optimistic ratings had overstated the safety of the securities being held by financial institutions worldwide. Lehman entered 2008 with a balance sheet heavily weighted toward real estate assets that were declining in value and increasingly difficult to sell, facing growing doubts among counterparties and investors about the soundness of its capital position. Through the spring and summer of 2008, Lehman's management and the Treasury Department and Federal Reserve attempted to stabilize the firm and find either a private sector acquirer or a government-supported rescue that would prevent an uncontrolled bankruptcy. The previous March, the Federal Reserve had facilitated the emergency sale of Bear Stearns, the first major bank to reach the edge of collapse in the crisis, to J.P. Morgan Chase, with the Fed providing financing to make the acquisition possible. The Bear Stearns intervention set a precedent, or appeared to, for government support for systemically important financial institutions that could not be allowed to fail in a disorderly way. In Lehman's case, the precedent did not hold. Negotiations with potential acquirers, most advanced with Barclays, the British Bank, and with Bank of America, broke down without a deal being completed. The Treasury Department and the Federal Reserve, whose principals included Secretary Hank Paulson and Fed Chairman Ben Bernanke, concluded that the legal authority to provide the kind of government support that would be needed to facilitate a Lehman rescue did not clearly exist, and that the political environment made using any available authority politically unacceptable so soon after the Bear Stearns intervention. The decision not to rescue Lehman was not simple or clearly correct, even in retrospect. The officials involved have defended it and been criticized for it in roughly equal measure. The bankruptcy filing on the morning of September 15 triggered precisely the cascade effects that the Bear Stearns rescue had been arranged to prevent. Lehman's bankruptcy sent immediate shockwaves through the global financial system through multiple simultaneous channels. Counterparties to Lehman's derivative contracts, obligations in which other financial institutions had agreed to exchange payments with Lehman under various market scenarios, faced immediate uncertainty about whether Lehman could honor its side of these agreements, and simultaneously faced the freeze of those contracts in bankruptcy proceedings. The interbank lending market, the market in which banks lend to each other at short term to manage day-to-day cash needs, essentially froze overnight, as banks that were uncertain about their own exposure to Lehman's failure and to the broader market stress it represented, became unwilling to lend to counterparties whose stability they could no longer confidently assess. Money market funds, which millions of individuals and institutions held as cash equivalents, experienced a crisis of confidence when the Reserve Primary Fund, one of the largest and oldest money market funds, broke the buck on the day following Lehman's bankruptcy, announcing that the value of its shares had fallen below $1 due to losses on Lehman commercial paper it held. This triggered a run on money market funds broadly, as investors who had assumed these funds were essentially risk-free began withdrawing assets simultaneously. The credit crisis spread globally within days, as financial institutions in Europe and Asia that held American mortgage-related securities or had counterparty exposure to American financial institutions confronted similar valuation and liquidity problems. The global credit market, through which businesses borrow to finance their operations and growth, contracted severely. Businesses that depended on credit markets for normal operating purposes, including many manufacturers, retailers, and commercial real estate operators, found their access to financing sharply reduced or eliminated. The contraction of credit translated into contraction of economic activity, reduced investment, reduced employment, reduced consumer spending. The policy response, the Troubled Asset Relief Program, the Federal Reserve's expansion of its balance sheet through extraordinary lending facilities, the bailouts of insurance giant AIG, and the government-sponsored mortgage enterprises Fannie Mae and Freddie Mac, and ultimately the fiscal stimulus measures of 2009, represented the most extensive government intervention in American financial markets since the 1930s. The costs of the crisis, in economic activity lost, employment destroyed, housing wealth eliminated, and public funds committed to stabilization, were measured in trillions of dollars. The regulatory response, embodied primarily in the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010, represented the most significant restructuring of American financial regulation since the 1930s as well. Lehman Brothers itself, the institution, ceased to exist. Its various business units were sold to different buyers in the bankruptcy process. Its North American investment banking business to Barclays, its asset management business to other buyers. The physical building on 7th Avenue in Manhattan that had housed its headquarters was eventually redeveloped. The executives who led the firm through the years of risk accumulation that preceded its failure faced regulatory investigations and civil litigation, but no criminal prosecution, a fact that generated significant public anger in the years following the crisis and that contributed to the political environment of the early 2010s. The legal and practical threshold for criminal fraud in the context of financial risk-taking that proves to be catastrophically misjudged is high, and the crisis-era mortgage market was characterized by practices that were, in most documented cases, legal under the regulatory frameworks and accounting standards of the time. However, clearly they appear in retrospect to have produced a building catastrophe. The financial system that emerged from the Lehman crisis was more regulated, more capitalized, and more carefully supervised than the one that had allowed the conditions for the crisis to develop. Whether those changes are sufficient to prevent a comparable crisis in the future is a question that financial economists and regulators continue to debate, and that will ultimately be answered only by experience.